Hi, guys. A very good evening to all of our viewers who've tuned into this fresh episode of Money Control Markets Weekly. I'm Karunya Rao. Joining me today is Santosh Kumar Singh from Motilal Oswal AMC to talk about everything that happened with respect to markets, business, and much more in the week gone by, and what will be some important factors, important cues, and themes to keep on your watch list. Santosh, thank you so much for taking time out and joining us.
Thanks a lot for inviting me.
Well, first things first, I want to know, this week has been quite eventful. Just today, if we look at it, we had good global handover. We also had the MPC meeting, which was largely in line with the expectations, the outcome of the MPC meet. And of course, we have TCS earnings later today. Uh, what is it, according to you, that really stood out during the week that really aided the resilience, or even in terms of the big outliers? What were the big outliers for you?
So the biggest outlier from the market perspective has been in stocks anywhere linked with, say, the digital space. So be it the likes of IRCTC or the IT sector, where the expectations from the result season is really, really high. So there is a very little margin of error in this particular space. Even if I'm looking at today, if you look at the markets, actually most of the things were down. What was up was Reliance and IT. So the expectations from the particularly IT space is really high, and that's what we will the facts will be checked in next 3 to 4 days, starting today.
Okay. What about the earnings season? Of course, today is the IT bellwether TCS that will be reporting its numbers in just about, in the next few hours. We'll see the commentary as well. But overall, if we look at the quarter gone by, which is Q2 of FY22, do you think it's going to be in line with the kind of momentum we saw in Q1? Will it extend that growth trajectory, the momentum that we saw?
So if we are talking from a YOY growth perspective, we may not be able to see the same thing because
Sequentially,
last year,
sequentially.
yeah. So that's why YOY it may not happen, but sequentially, I think this quarter is going to be much better than what we saw in Q1 for most of the sectors, because most of the sectors are linked with the economy, and this has been a much more normal sector than what we have seen over last 4 or 5 quarters. So I would expect that the momentum from an earning point of view will continue. Now the question is, will it continue in line with the expectations which have been built by the market participants? Because somehow I find that in certain sectors the expectation built up is more than what the market may be able to deliver.
Okay. But one sector that's very closely linked with the economy and the state of the economy is the auto space, which was very quiet and very subdued all
Yeah.
this while. Even that started picking up meaningfully in terms of the stock moves that we've seen earlier this week. So, what is your reading of the auto space right now? Is it a good time and a good level, perhaps, in terms of valuation for one to look at?
See, when we are looking at auto space, what we need to remember is that it's not only the economic factors which are playing out there. So in auto, you have got three areas, right? The commercial vehicle, the passenger vehicles, and the two-wheelers. Commercial vehicle, in my view, there is no disruption coming from any technological point of view, and even the other disruptions related with availability of the parts is not that big a problem in that particular area. So that should do really well. Passenger vehicle, I think it's a short term disruption because of some of the factors, but the sort of EV part may not be a disruptor in the near term. So I would think that even the passenger vehicle is well placed, but within passenger vehicle we may find some on the stock side things happening and going here or there, but as is the passenger vehicle sector per se is well placed. Two wheelers is where my personal view is that the demand in the market itself may, firstly, the demand may not recover the way people want it to recover. And second, even the disruption due to the EVs is going to catch up much faster in the two wheeler space. So I would actually like to look at auto sectors differently. Auto comps for a passenger vehicle, commercial vehicle, I think it's a good place to be in. Two wheeler maybe and space. My personal view is maybe see some disruptions, and there I'm not very clear how. Uh, or what can happen over next couple of years.
So, which sector do you think looks the most stable and the most promising right now? Because our show essentially we talk about actionable ideas and themes and sectors, especially from a retail standpoint, what retail investors could be looking at and how they should plan their strategies. So, from a stability standpoint and from a outlook and fundamental standpoint, where do you see the most amount of promise at the current juncture?
See, I would believe so. I will put it into with one is the stability from earnings point of view, and then the valuations in that sector should not be really high. And the sector which strikes me really is the financial sector, because that's if anything happening with the economy, the biggest beneficiary is always the financiers of that particular sector, and financials is going to be the sector, the theme maybe for next 3 4 years if the economy has to do anything. And the valuations in this particular space is not expensive. This is the sector which is not participated for maybe last 1 or 2 months. So and what we are seeing a great amount of recovery. Even the NPL cycle is over, the recovery is going on really well. So this is one sector where I would think if one is looking at stability as well as earnings coming in and the valuations being right, so I would bet on this particular sector.
Okay, all right. But why is it that, financial space has failed to participate in the up move? Because you rightly pointed out, which is the case, right? Banks and NBFCs have not really caught up with many of their other peers from different other gauges. Why do you think that has happened? And by when do you see some meaningful pickup coming in? Maybe is it this quarter or next quarter? What is your assessment?
So see, the way I look at the markets are also about demand and supply, right? The supply of money will decide, and the demand of the stocks. It's just not about the valuation or the earnings. Now, and I'm generally, and more so in the recent times, the sector which is the fancy sector of that particular quarter, most of the money flows through into that particular sector, and the stock movements are exceptional in that particular area. So the fancy for last 1 quarter, I would believe, was not the financial sector. It was somewhere else. And even what we are looking at, that so many IPOs coming in, a lot of the money is being absorbed by some of the IPOs which are coming in, and those IPOs are not in financial; they are mostly in the digital space. So so the demand of stocks per se in that particular sector was not very high, and it was not the fancy sector for the retail as well. But my belief is this particular result season might change it, because what when you will see that the numbers are one of the best and the valuations are one of the cheapest, then again, and that's one part I find the problematic with the market. Then when the market catches fancy, it moves it towards to a different level. So it might move to a different level in next 2 to 3 quarters. But I think this will be the quarter to look out for. And unless and until by December we again see a great big third wave, this is the quarter we need to look out for.
One space that you understand very well is definitely NBFCs and housing finance companies. What kind of names do you like there, or what kind of subsegments should one look at right now? Do you have a favorite?
My favorite is housing actually. So
Okay.
I think, and I'm not talking about just the housing financials, the entire housing space actually. It's because I think it's coming from a 8 9 year of very bad phase. And the problem is of the bad cycle is not only, so one, the volumes fall, and secondly the prices also fell. So you have a multiple impacts, and now we are coming off from 8 years of no pricing increase or pricing fall in a particular segment. And the financials in that particular space also tends to suffer if the pricing tends to fall, because they are going to follow the core sector, and the effect is multiplied in case of financials. So my view is the impact of all the NPLs may be visible for a couple of quarters, because there is always a right of lag. But this is one area where this is the cheapest segment of the market, and I would believe the growth rates may be one of the sharpest here, and it might sustain for multiple years. So this space, I'm really bullish on.
Okay. Uh, Santosh, I don't know how well you track the aviation space, but I just got some updates coming in. There's a press conference underway where, they're talking about Air India divestment, and of course, the potential or the highest bidder is Tata Sons. So, how do you see things playing out in the aviation space now that, once again, travel and the economy, businesses are reopening? Is travel or rather aviation a good bet, or should one look at alternates like QSR and hotels, etc.?
So I would say travel is a great bet. Aviation, I don't know, because the problem with aviation has always been that whenever the demand comes in, uh, somehow it supply tends to come in much faster than demand. So that's what we have seen over years. That whenever you see some bit of demand recovery, the supply comes in and the pricing goes out of hand. So that's where one needs to be worried about that part. And this is a global phenomena. It's not just India. This is one sector where very few people would have made money. Very few stocks people would have made money. So that's where the problem is. And I'm expecting that Tata and Sons, if the Indian Airlines is going to be with Tata and Sons, they may not be the ones who will start a pricing war. But nothing can be said with surety, given that there are other players also coming in and everyone would want some spy of it. So I would think more than aviation were the areas like hotels, uh, maybe anything related with outgoing activities, maybe the restaurants, the hotels. These are the areas one would rather want to be in. QSR somehow they were the biggest beneficiary of COVID, and from
Hmm.
a stock price perspective, they were the biggest, and not necessarily from the EPS perspective, because I have not seen any stock where the EPS pre-COVID and post-COVID, the EPS is higher than pre-COVID, but the stock prices are multifold of pre-COVID. So they were the biggest beneficiaries of the COVID from a stock price perspective. So I don't know, but that is one space I may not be that much sort of bullish on, as I am on more so on the travel side or the restaurants or the hotels. So that would be another area I would definitely feel one should look out for.
Okay, all right. Let's also get in some viewer queries as well, because we get a lot of engagement typically, and a lot of these viewers and retail investors specifically want to understand big and important phenomena that are playing out in the markets. I just want to address IT once again, because one of our viewers says that the demand for IT talent has really surged. Attrition is increasing across companies. So, should one expect in that backdrop better margins for IT this time around? Because yes, there is a massive supply side issue which even persisted in Q1 and perhaps has deepened in Q2.
So see, what has helped IT is multiple years of demand getting bunched up and coming at one and coming into that sector at one go, and they were also not prepared for that, and that's why you are seeing the sort of attrition you are seeing. The attrition levels have gone up, and that's why you have to pay much more for from on the salary side. So on a demand front, given the everything came together, what we saw, and still that demand has to flow through into the revenues because it flows through over a period of time. So you might see multiple years or maybe 2 3 years where the overall revenue growth will be much higher than what it was in the past. But would it mean that there will be a significant increase in the margin in the near term? My view is that, see, the first phase will be you will see some margin pressure and then followed by, say, maybe margin increase, because initially you will have to pay to hire, and then second is that the if travel and all other expenses starts flowing through, then there will be some impact to the margins in the near term, maybe followed by a margin expansion over next 1 or 2 years. But what is clear is that there is a demand which has got bunched up, which has come through, and which will have an impact on the top line for 3 4 years. Now, the question which everyone needs to ask themselves, that what they want to pay, because what we need to remember is that when the market treats a 20% growth rate stock very differently from a 15% growth rate stock, and the fall in the P ratios are totally different. So we have seen in 1999 and 2000 the same, it's happening where the companies went to 100 P, and from there they traded at 15 P for multiple years. Again, they have moved to 50p. Now, I'm not saying that they can't stay at 50 or 45 or 35, wherever some of the companies are at 50, some are 35, but all of them are at one of their highest valuations in last at least 1.5, 2 decades. So one needs to see the valuations also with the demand scenario. So that needs to be kept in mind. So that will be my only
Digital.
advice. Yeah.
Right, right. I just want to keep it with the technology space because digital has really showed up in ways that nobody had imagined in the last 1.5 years, right? So whether it's IT, whether it's software, hardware, bellwether companies, mid and small cap IT, consumer tech, is there a pick that you have within the wider basket of IT when we talk about it? Any of these subsegments that are attractive right now that people perhaps are not paying enough, or rather not giving enough merit to?
So if I were an individual retail investor and if I'm investing in stocks, I would rather stick with the IT sector itself rather than getting into the digital and platform companies. Because my view is that you are going to these are the companies with there will be one or two which will be one of the largest companies in India in next 10 years. But the problem with the sector is that in IT sector you have got 5 or 6 companies which are huge, right? The digital space is an area where everyone is trying to create sort of a monopoly or a duopoly, and most of these companies don't have profits to latch onto. So if the successful companies may be huge after and huge by some margins, and we are talking about very large scale in next 5 6 years, but the ones who are not able to become successful or not be able to come into the top three, there the sort of value destruction can be even complete. And that's where one needs to, in this particular space, one needs to have uh, I would say a very different approach than what a traditional investing is all about. That if a sector is doing it well, you will have 10 stocks, 10 companies doing really well. But here it's not going to be 10 companies doing really well. Maybe two or three might do well, others might fall aside, and that's what we have seen globally. So one needs to be uh, when aware when and differentiate between the traditional IT companies and the new age platforms or the new age digital companies. They need to differentiate between those.
Okay. What is your view on the power and energy space? Because there has been a lot of news flow when it comes to the energy crisis. There's also a lot of talks going on about energy inflation as well. So, any of these talks or any of the companies in the Indian ecosystem that stand to be impacted?
So there are a lot of talks about coal shortage and all, and that's actually impacting a lot of Indian companies positively. But power sector per se, if you're looking at, again, that is one which is coming back after 13 years. I mean, that sector, after all those ultra mega power plants going for getting into trouble, that sector was forgotten actually. If you ask on the sell side how many power analysts are remaining, you will be able to count on your
Hmm.
fingertips. So that is another sector where the problems for last 13 14 years has meant that no one has gained anything. Now there are multiple reforms happening. Today also there was one particular reform which is going to sort of have quite a big implications on the way power trading happens in India. So there are multiple reforms happening which is going to have quite a lot of positive impact on the power sector. But again, mind you, here also retail, if you are a retail investor and if you don't understand P&Ls or balance sheet very well, you should not get into too much of excitement. This sector is going to make a lot of money, but yes, you should invest time into and reading the balance sheets of these companies before starting to invest.
Of course, that applies to any companies, in fact, not just power sector, but of course, the coverage is much less, the exposure
Yeah.
and the news flow is also typically less. But coming back to the earnings this time around, are you concerned about any pack or any red flags you see that could play themselves out? Like, could there be any downside risks?
So as I said, I would really means that would be my want actually. I would really like the tech sector to deliver. It's something where we can't afford a mess. Everywhere else there is a lot of margin built in from a market perspective. But tech sector needs to deliver. That is one sector because there the expectations are sky high. So that sector needs to deliver, and whenever the expectations are sky high, I am more worried about the sector where the expectations are too much. Okay. So I know, and all the data is telling you that tech sector should do really, really well. But the way we are as investors, we tend to have an sort of expectations which is somehow becomes different from what the companies can deliver. So that's the one sector I would really want to look at, and I would hope that this sector delivers. Because otherwise, means the momentum of the market can move in a different direction.
In terms of market mood and how things are playing out overall in the larger market, how do you see things going by the end of this year? Because markets have seen periods of exuberance. There was a phenomenal run up. Then, for the last few weeks, of course, we saw some jitteriness trickle in because of whatever was happening in several global markets. But going forward, if one has to understand or identify key monitorables to watch out for or to keep on their radar, what should those factors be?
So I think there is only one factor which I want to look at is what's happening with the earnings.
Okay.
Now, clearly, if what government is trying to do on the capex side, because see, ultimately capex is one area which needs to recover for you to have a sustainable market, because a lot of things are dependent on the capital formation. So if the capex cycle keeps on going, or the government keeps on spending, because they will have to spend first and then the private capex may start. So if the government keeps on spending on the capex side, and if the real estate, this is another area one needs to, because what we tend to forget is that real estate is one of the largest employers in anywhere in the world. This is one of the largest employers, and it has a significant impact on the economy. Means it will be the autos and real estate will could be two sectors who have got disproportionate impact on the economy. So I would really want to look at these two sectors doing really well, and if the data coming out from these two sectors is fine, then what we could see is that the impact could be on multiple other sectors across the economy. So these will be the two key areas I would like to keep monitoring, actually, the real estate and what's happening on the auto side and the capex cycle. These maybe these three sides I would like to keep monitoring.
Okay. Typically, when a new investor has, just stepped into the markets or is still, keeping at bay and trying to enter the markets, what would be the one advice you would give to them? Because everybody wants to wait for the right price, the right valuations, but is it ever a good time?
I don't think it's ever a good time, because I mean, whatever journey I had, I never found a good time to invest. Sometimes I'm worried, and sometimes I'm worried that things might go bad. Sometimes I'm worried that the valuations are too high. So I'm always worried. So that's why I would say that if you want to invest from today itself, but be an investor. So it's very different from trying to make money in the market by trading. Be an investor if one is one, and try to understand what you are trying to invest into, because what we have seen, and this phenomena is not new, but it has increased over the last 2 3 years. Is that people are trying to get into the hottest stock. So and I have realized from that 2007, 8, 13, 14, and then 17, 18, I've realized that where you get hit are the most hottest part of the market. You get hit very badly. So don't go for the hottest area of the market. That's my advice to anyone. But there is no time for investments, and you should start today if you want to.
And what would be the best way to craft your initial portfolio? Let's say I have 1 lakh rupees to invest today. How would you suggest that I divide it across different sectors or asset classes overall? What would be your advice there?
Say, means I'm not a financial planner. The way I think, I will talk about how I do it. If I
Yeah, exactly.
because, uh, the problem is how we do it as a portfolio that I can talk about, rather than what a financial plan. So they think that the so one thing we keep in mind is that, see, you want to look at return on capital, but first think about return of capital, because return on capital is the excitement part, but return of capital is the pain part, you know. So that's why when you're creating a portfolio, at least 50 to 60% of your portfolio should be such that where you are assured that actually you're not going to lose most of the money to generate that 200% return. So at, at least 50 to 60% of the portfolio should be core very high quality stock. And then uh, one thing I was taught from the first day, that there is no price to be paid for a moral hazard. So if you are worried about governance of any company, means whatever the price is, you should just avoid it, and whatever the upside you can see in the market, you should just avoid it. So at least 50 to 60% should be the very high quality stocks, and then rest of it should be again quality and high growth or whatever you want to invest in. But just remember that means there is no price for governance lapses. The ultimate price is only zero. So that's how we want to create our portfolios.
Absolutely. On that note, Santosh, thank you so much once again for taking time out, for answering our viewers' questions as well about various sectors and developments that are taking place in the market, and for sharing your insights.
Thank you for having me.
Thank you. Have a great weekend.